Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 43 in our series for 2024, and today's date is Friday, November the 22nd. First, I'll be talking to Andy Cunningham, the Senior Regional Director, Australia-New Zealand at Autdodesk. We'll examine Autdodesk research showing how Australian design and make companies, so architects, engineering, construction operations and manufacturing firms, are behind the rest of the world in the kind of digital maturity they need to digitally transform their businesses. And I'll be talking to Indeed economist Callum Pickering about Australia's latest jobs figures and what they mean for the Reserve Bank of Australia. But first, let's talk to Andy Cunningham.
Well, Andy, tell us about this research conducted by Autdodesk about Australian organisations in the design and make sector. How digitally mature are they?
It was interesting, Leon. We spoke to about 2,500 organisations around the world, approximately 250 from Australia to get a local perspective as well. And there was some interesting sort of facts come out. Australia fared fairly well in quite a few areas, but sort of lagging in others as you'd expect as well. So we found that 36% of all organisations regard themselves as digitally mature, which is actually slightly behind the world average in that regard. And of all organisations that responded, only 15% have actually achieved their goals. See that as a fait complete in that process. So a lot of our organisations are along the way, as part of that digital transformation journey.
So how many Australian companies have actually achieved their digital transformation goals?
Of the sample, I guess there was about 260 Australian companies, so 15% of that. So if you extrapolate that out across the industry, it's obviously more than that. But 15% was the actual feedback that came back and said they're done. Now, I mean, it's an evolving journey as well. You could argue that it's never complete at the same time. You don't sort of dust it off and say we're done here. But a lot are on their way at least. There was only 22% that said they're actually in the early stages. So the vast majority are certainly moving through that transition.
So these are design make companies. These are in architecture, engineering, construction.
Yep. Architecture, engineering, construction, operations, manufacturing and product design as well.
Okay. How does that compare globally?
Well, it's interesting. We were slightly behind, I guess, the global average as far as the completed status. So a little soft in that regard. We're also, interestingly, if you look at the area, one of the areas of digitization and one of the drivers is sustainability. And we are actually surprisingly behind the world in sustainability as well. So again, of those customers surveyed or clients surveyed, only 13% actually had clear goals for carbon neutrality within their organization, which is about 10 points behind the global average there as well.
What are the big issues of these companies achieving this digital transformation?
It's interesting. I've got my own perspective on that. As far as the survey, I guess the biggest one was attracting and retaining talent. And we certainly found that over the past few years where it's difficult to import talent. That's starting to open up now, obviously, with immigration and the borders opening post the pandemic. But attracting and retaining talent is still the biggest challenge that we see out there. Managing costs, obviously, especially in the current economic environment. And then the third was reacting to global volatility and economic events. So that were the three. My own opinion of that as well, I guess, outside of the survey, a lot of customers or a lot of clients embark on the digital transformation journey. They see it as a whole of business initiative, which is great. But there's a bit of a paradox in there. I think you need to have it at the boardroom as far as the discussion, with an understanding of metrics and returns and value. But you also need to start slowly and bite what you can chew. So we see a lot of customers think it's actually a whole of business transformation, then it all gets too hard and then it gets sort of parked and put away again. So it's sort of balancing, I guess, a step-by-step approach, a project-by-project approach, but still having company-wide KPIs and understanding of that as well.
But it has to be adopted at a board level.
It has to be understood and measured and invested at a board level. If we see, when it's not, we see these small projects that can be successful, but either just stay at a project level or die on the vine. So we see the investment required the initiatives certainly are at a board level, because it drives growth. That's the thing. What we see again in our work in our research is clients that have actually transformed or are in the process of transforming are really more productive, more competitive, and more digitally mature as well. So that they're winning more work, they're more cost effective as well. And again, of the entire worldwide survey that we did, 79% of respondents said the future of their company will depend on digital tools. So that's why it needs to be at the boardroom level.
I mean, but one of the big issues with all companies, well, particularly in Australia, but I think it's also worldwide, is productivity.
Mm-hmm.
And so this sort of transformation would enhance that, wouldn't it?
It does. It certainly, I mean, especially when you think about attracting and retaining talent is a challenge. And then in particular in the construction industry, productivity has not really changed for years. For 50, 60 years, we haven't really evolved as far as productivity in construction. And you can see that on sites today. The adoption of digitization or digital in the construction in the field itself, not in the design area, but actually in the field, is one of the greatest laggards of industries that we see right across the digital spectrum. So the productivity benefits are certainly there. The alignment, I guess, of design, engineering, construct, and then into the field, alongside productivity, has reduction of waste, reduction of cost, better sequencing, etc. as well, because we're actually controlling what's happening on the field in the environment, as opposed to the very rampant waste that we see in construction today. So human productivity, yes, and resource productivity or resource conservation as well.
Why are they having difficulty taking it out into the field?
Part of it, I guess, is traditional. Traditional the way it's always been done. It's if you think about a construction site, and traditionally, it's a fairly labor-intensive, manual labor sort of environment. What we're seeing now with digitization, both in the design element and what that lets us do, and also in the field itself, the technology is finally actually bringing those sorts of enhancements to the field. So there's been many years where we've seen a great 2D or 3D design. It's a BIM model, it's 3D, it's fully constructed, etc. And then it gets printed out on an A0 plot, and it gets put in the work shed on site and gets rolled out. And 5 minutes later, it's out of date, no doubt. And you've got those gaps there. We're now seeing the technology actually let the digital design get taken out to the field and used in real time, so that it's synchronized with any changes, with any issues and what have you. So that's starting to, the advent of technology in the field is certainly driving it. I think what happened with the pandemic over the past few years as well, as far as resource availability, the need for sequencing brought a real need to that, and now cost. If anyone's tried to do a renovation on their house or build a home or do any sort of construction work, whether it's small scale right up to the large projects that we've seen, costs are through the roof. And so there needs to be better control of materials, better control of human resource as well, to minimize the cost element.
One of the big issues would be actually training the workforce to actually embrace that. How big an issue is that?
It's huge in all honesty, because what we're seeing is the changing nature of work at the same time. There's robots out there that will lay bricks, quite literally. You give it the plan and the robot will place the bricks out, on the plate. And everyone says straight away, oh my goodness, that's the end of bricklayer work. No, it's actually saving a lot of backs for a start. And it may change the way we actually, work in those sorts of areas, from maybe manual labor to more digitally aware sort of skills. So the skills gap, I guess, at an initial area from education and STEM students, etc., coming out of education, university is a concern, but also the enhancement of skills of people that are in the workforce today is the other side of this. And what we're seeing is the traditional classroom element. It largely doesn't exist these days. People don't go to a class to learn how to do a particular task. So we're finding the need for more in situ, in context training, as the job is happening in smaller bites, is more what's needed today.
Well, the issue is that you're actually training, say, bricklayers to work digitally. So you're not actually taking away jobs, you're actually creating jobs, in effect, aren't you?
Correct.
Because the experience with artificial intelligence and robots is that they do need human vetting.
Absolutely. And that's the shift, I guess, as I said, and you're dead right. You're not taking away jobs, you are changing it, and they're amplifying. We have a skill shortage in that area massively across Australia, and that's something we need to address. And I think that's where government and industry and technology companies such as ourselves really need to partner and work better on that, because it's a real tripartisan requirement in the industry. We're technology providers, solution providers. We have industry and the consultants and contractors that are delivering, and the government's got a huge part to play in delivering education, curriculum, and the right standards out there as well.
Yeah, so that's quite a big challenge then for all industry, isn't it?
It is, and we've seen countries overseas, start to address that through things like BIM mandates in the UK or in Singapore even. And it's something I think in Australia, as I said, maybe due to the tri-level of government here, and maybe due to the sort of tripartisan need that we need, as I said, with industry and technology, it's something we need to address, both in the education space and also just in the digital standards that we have across the industries in Australia as well.
Well, Andy, it's been fantastic talking to you, and thank you very much for your time.
Great, really appreciate it. Thanks, Leon.
And now let's talk to Indeed economist Callum Pickering.
Well, Callum, unemployment remained at 4.1%, and that's the third consecutive month in line with market expectations. So what's your view about this?
Well, it's a clear sign that from an unemployment standpoint, that the market sort of stabilised a little bit. We obviously had an unemployment rate that was gradually increasing over the course of 2023, even early 2024. But that sort of shifted a little bit in recent months, with it sort of remaining at that 4.1% level. Overall, when assessing the latest job figures, I think they remain really strong. It was quite a positive set of data, perhaps not as strong as we had seen in recent months, but I think it consolidated a lot of those recent gains that we have seen. So the fact that we didn't sort of backtrack after a few really, really strong months, I think is a good sign around the health of the job market and the resiliency that we're seeing in the job market as well.
So how many new jobs were created?
So employment was up 15,900 people in the month of October. Now, that number by itself is not a big number. I mean, it doesn't keep pace with population growth. So if we were just to focus on that, we'd say, well, maybe that's a little bit of a negative. But if we take a step back, we can see that over the past 6 months, employment's increased by 255,000 people, so an average of more than 40,000 a month. So you sort of need to look at that 15,000 figure within that context. So Australian employment has been growing at a rapid pace over the course of 2024, and there's really no signs that is slowing at the moment. I mean, I have access to a lot of forward-looking measures of labour demand, such as job postings on Indeed, and what I'm seeing is that there continues to be really strong job creation. So there's good reason to expect that employment is going to continue to increase at quite a rapid pace for at least the next few months.
What particular sectors was employment growing in?
Well, we don't necessarily get an industry breakdown with the latest labour force figures, but we do know a few things. So one is that healthcare, education, professional services have all been very strong drivers of employment gains over the past 6 to 12 months. And there's no reason to think why that wouldn't continue to be the case in the near term. It's been well publicised that a lot of jobs being created right now have been sort of government adjacent, sort of influenced by government policy. The big one has been the NDIS has been driving a lot of jobs in recent years, and certainly overall, the healthcare and the care industry has been the big driver of employment gains pretty much since the pandemic began. So that's sort of where the jobs are likely to be concentrated. We will know a little bit more when we get the latest quarterly data, which will come when we get data for November next month.
Okay, and the participation rates?
Well, the participation rate had been breaking records almost every month, but it took a slight step back in the month of October. It was 67.1% in October, down from 67.2%. But obviously, given that we have been setting so many records with regards to participation lately, that is still a very good result. It's the second highest that Australia has ever seen. And that participation continues to be driven by a couple of factors. One is that there's lots of jobs available. Australia continues to create an incredible number of job opportunities each and every month. So there's lots of jobs out there for those who want them. And the other major factor has simply been that, we continue to face these cost of living pressures. And so there's a lot of households that are looking for, a second job, or maybe they need, 2 incomes or something like that. So that's probably contributing to some of that upward pressure we have seen on the participation rate over the past few years.
Does the problem continue that a lot of employers are finding difficulty tracking down suitable workers?
Well, that continues to be a challenge. It does. Like I said, the Australian economy continues to create a lot of jobs, well above what was considered normal before the pandemic began. And now, a consequence of that is recruitment remains quite challenging, and there continues to be skill and talent shortages across most industries in Australia. So that means that recruiters are sort of having to cast a wider net. Sometimes they're having to make compromises around experience or education in order to fill certain roles. And then there are roles that sort of go unfilled for extended periods of time. So it does continue to be quite challenging from a recruitment perspective. And as part of my job, I do tend to talk to a lot of recruiters and employers and sort of get their sense of what the job market looks like. And that's a pretty consistent sentiment among those I talk to.
So where are the big shortages?
Well, they continue to be in industries like healthcare is the most obvious one. I mean, even though we've seen big increases in employment across the industry, we continue to not have anywhere near as many nurses or doctors or aged care workers that we need to sort of meet the demand for those services. But what's been unique over the past couple of years is that the skill shortages or talent shortages or recruitment difficulties have been prominent pretty much everywhere. In the past, it was always concentrated in just a few industries, and they were usually really highly skilled industries that required extensive education, healthcare being an obvious example, education, maybe professional services. It's much more widespread now. So even relatively entry-level roles in hospitality or retail, working in cafes and restaurants, experience some pretty consistent shortages now compared to what we were accustomed to sort of before the pandemic began.
Which would explain why a lot of cafes and restaurants seem to have staffing issues.
Well, that's right. A lot of them have been operating below capacity for a number of years now, and it's been really, really challenging. It's actually a really interesting dynamic because it's one of the reasons why employment gains and job creation has remained so strong, despite the fact that the economy itself hasn't necessarily been doing that well. Normally, that's a dynamic that doesn't exist. I mean, the economy is growing poorly. Usually, you'd expect job creation to sort of follow suit. That hasn't been the case this time. And one of the reasons I suspect is because so many Australian businesses were operating below capacity in terms of staffing. So even as the economy has stopped doing particularly well, they still need more people. They don't want to be operating below capacity on an ongoing basis. So they still need to hire more and more people, despite the fact that, the economic growth dynamics that we have right now would suggest that maybe employment should be stagnating.
What's interesting is what this will mean for the RBA, because the RBA is very much alert to the job market. They made that quite clear in their last statement. What's your view about that in terms of interest rates?
Well, right now, the job market is tracking pretty consistently with RBA expectations. They would have expected the unemployment rate to be around 4.1%, 4.2% maybe, and that's exactly where it is. Obviously, job creation remains quite strong at the moment. And we also got wage data this week, which indicates that while annual wage growth has come down quite a bit from its peak, it still remains quite high. So when I look at those labour market dynamics, I think it's very difficult to form an argument in favour of rate cuts in the near term. And it hasn't been a surprise that a lot of market economists have shifted back their rate cut expectations. A few months ago, everyone was talking about February being the date the RBA was going to cut rates in February, and that would begin the loosening cycle. Well, they've all been pushed back to May now. And when we're thinking about monetary policy moves sort of 6 months from now, there's a lot of uncertainty around that. Okay, so a lot of things are probably going to have to change in order for the RBA to deliver rate cuts even by May next year. And one of those things is probably the job market. The job market is still really, really strong. And it's not the sort of job market that you would expect to see when you begin to cut rates. There is also the concern that wage growth remains much stronger than productivity growth. So there's a clear disconnect there. And what that essentially means is that domestic inflationary pressures are likely to be quite strong in the near term. So if the RBA is going to get back to its inflation target on a consistent basis, it's probably going to need to rely upon imported prices rather than prices being generated domestically. And I think the RBA would be a little bit concerned about that. And I think ultimately they would like to see a lot more progress being made on service sector inflation and wages in order for them to be confident in their ability to achieve the inflation target, but even more importantly, stay there. Because you can sort of get there maybe temporarily, but staying there is the bigger challenge.
Well, the service inflation was around same level it's always been at, say 4.5%. And so it means we haven't made any progress there at all.
Yeah, very little progress from its peak. It has come down a little bit, but certainly in the last few quarters, there has been very little movement at all. A lot of the service sector industries are those that have not been affected by government subsidies. So we haven't sort of seen that shift down that we have seen in other areas of the economy. And ultimately, I think the RBA would like to see service sector inflation probably in the low 3% range, which is a pretty far cry from 4.5%. If they're in the low 3% range, and typically inflation on goods is lower again, typically between 0 and 1%, depending on what's going on with exchange rates and things like that. If you have that sort of dynamic, then typically you're going to have an inflation rate of between 2 and 3%. So that's sort of exactly where they want to be. But right now they're pretty far away from that. So they could get, headline or core inflation down to 2 to 3%, maybe due to goods inflation dropping into the negative range. But that's probably not sustainable on a long-term basis. So they need the service sector to do a little bit more of the heavy lifting in order to consistently meet their target.
Right, and so we mightn't see a rate cut until at least the first quarter of next year and possibly later.
Yeah, I certainly don't expect anything in February, and I think most economists have moved away from that. May is still possible, but like I said, I think some things need to change in order for that to be achievable. Right now, the dynamics we have, whether it be inflation, whether it be the job market, isn't really consistent with what you would expect to see if you're on the verge of cutting rates. Now, obviously, 6 months when we're talking about economy is a long time, and things can obviously change. But we just need to bear that in mind. It's far from certain that these rate cuts will be delivered, even though there is that widespread expectation that the RBA will cut rates next year.
Well, Callum, that's all very sobering. And thank you very much for your time.
Thanks, Leon.
So what's happening in the news? Well, Chinese leader Xi Jinping told US President Joe Biden that he's ready to work with Donald Trump to improve the relationship between the world's biggest economies. Speaking at the start of what's expected to be their final meeting before Trump takes office, Xi told Biden that the US and China should strive for peaceful coexistence over the long term. He said solidarity and cooperation are needed to help humanity overcome difficulties, adding that neither decoupling nor supply chain disruption is a solution. Biden has just about 2 months before he hands power to Trump, who has threatened 60% tariffs on China, a level that risks disseminating trade between the world's biggest economies. Early appointments by the president-elect, including China hawks Marco Rubio as Secretary of State and Mike Waltz as National Security Advisor, suggest he's readying an adversarial stance towards Beijing. Biden and Xi have sought to stabilise relations and build on a summit a year ago in San Francisco, which reset ties after his administration shot down a Chinese spy balloon drifting over the continental US, and former House Speaker Nancy Pelosi visited Taiwan, prompting Beijing to hold military exercises surrounding the island. Taiwan remains the biggest military flashpoint between the US and China, and the most sensitive issue for Xi. And some disgruntled X users have moved over to the social media platform Bluesky